So before we get started, I want to tell you a little anecdote. So I remember vividly 2007 when I was still sitting on a trading floor. And in July 2007, the money markets froze. And we were imagining what the future would look like. And at the same time, the press at the time was running titles such as this one, that effectively growth was starting to grow in 2008. Paulson saying that he believed still in May 2008, so quite a long time after that. The worst was behind us when we were just at the beginning. And that reminds me of the titles that we're seeing today. The stock market has to rally, just said, and by April we'll have a V-shaped recovery. So it seems to me like a lot of wishful thinking. And if you want to compare that to what was happening then and now in the real world, these offer you a nice comparison. So financial markets, in other words, are always lagging in reality in a way, which is counterintuitive, but that's the way it is. And if we look at, for example, some of the big stock market movements during the last significant economic crisis from 1929 to today, this is how the current stock market adjustment measures up to those previous significant economic crises. So there's still a long way to go if we assume the current crisis is going to be of a similar magnitude to some of the more recent ones, or the previous ones. Now, you may want to wonder, why is it that history repeats itself? And I found this very interesting statistics. Only about 15% of traders that are today in a decision-making position were in a decision-making position back in 2007. So that might tell you a little bit of why there's a lack of memory and why financial markets are still responding in a way that doesn't seem very appropriate. Now, what happened to the old traders? So if you want to know why they're no longer there, this is a picture of the UBS trading floor before the last financial crisis. This is a picture of the floor just a few years ago. Now, let's move on from this anecdote and let's move to the more interesting part of the presentation. We're going to share with you our views on the crisis. So we think in sum that it's going to be much worse than a great financial crisis. And I'm going to share with you our analysis of the situation. The current crisis is systemic in nature. We think monetary policy is not going to be sufficient at bailing out sufficient portions of the economy to restrain the effect of the crisis. And also we think that the fiscal policy transmission mechanisms are not working as they should. And we look at implication for financial litigation. This is an interesting chart of credit spreads, so a measure of distress in the credit financial markets. And you can see on the right-hand side that from 6 months ago, pretty much all the markets have moved in tandem. When we look at a sample of asset classes. So this just very well illustrates about the effect of systemic risk. This is a chart that nobody talks about. And we've taken a look at what proportion of interest costs paid by leverage companies was in 2007 versus what is now. And if you look at the structure of interest paid on leverage loans back then, about 80% of that was LIBOR and only 30% was credit margin. Following the significant drastic reduction in interest rates since then, today LIBOR only represents 20%, 23% of leverage loans interest costs, which also means that central banks are not in a position to bail out with pure interest rate policy these kind of very leveraged sectors of the economy. And that's a very important chart. The last point I want to make is that about the fiscal stimulus. Now, big numbers have been announced throughout the world in terms of fiscal stimulus, but here we're going to focus on one crucial element of it, which is the stimulus to small and medium enterprises. We looked at US, UK, and Europe. About 50% of the Western economies is driven by small and medium enterprises, which means that if this part of the economy stops, and about 60% of employees come from small and medium enterprises. If this part of the crucial sector of the economy stopped, then the whole economy stops. And if you look at how efficient the fiscal stimulus is in 3 countries in which it has been announced, you can see in blue the amount of monthly payrolls that small and medium companies in this country have to pay versus the amount of loans or guarantees that have been granted so far, which is dwarfed. And so we think that this is a crucial aspect that will drive our view of what's going to happen. And so we expect high default rates for SMEs, leveraged corporations, and consumers. We think investment-grade corporations are largely going to be okay because they can issue bonds that can be purchased on the balance sheet of the central banks. But we also think, crucially, that some banks will need to be bailed out. And the reason why I'm saying that is illustrated by this chart. We just done a projection of losses across some crucial asset classes which are going to be troubled. And you can see here that the capital tier 1, core tier 1 capital ratio of US banks and European banks is going to be reduced quite significant by 2 to 4 percentage points. And these are average figures, which means that in the basket you've got banks which are going to affect a lot worse than this. And so we expect significant amount of bailouts in the banking sector. So let's move on and look now at the impact of this view on financial assets. There are 2 crucial factors that are going to drive the severity of the crisis. The first is the amount of leverage in the system. There's been about 70% increase in global debt in credit markets since 2007. This is a significant number. And what it means is that the whole system is highly unstable. The second factor is the credit quality of this kind of loans, this kind of debt. This is just a sample chart, but the same chart can be replicated for other asset classes, for leverage loans. And it shows that the percentage of leverage loans that have no covenants, so no protections, or very few protections for the lenders, has grown from 15% of the total to 80% between 2007 and 2019. So what does this mean for financial assets? Higher default rates than during the financial crisis. We expect 1.5 to 2 times higher default rates. And we expect lower recovery rates because of the high amount of leverage and the high amount of debt in the system. So we wanted to show you the impact of these 2 crucial points on some asset classes. Here I have put a chart that illustrates the amount outstanding of some crucial asset classes that we think are going to suffer large amount of losses, from residential mortgages to high yield bond. And we have compared the amount outstanding of these asset classes in the US to Europe. And we also give you an indicator of what we expect, relatively speaking, these asset classes to perform against each other. None of them have got a sun, but some have got a storm and some have got a cloud. So for example, we think the leverage loans are going to be as badly affected in the US as they are here, more or less in Europe, simply because it's going to be very hard to bail out highly leveraged companies. On the other hand, we expect, for example, SME credit to be worse affected in Europe than in the US, because we think that the fiscal stimulus in the US is better transmitted. It's reaching the companies better. It's going to reach companies better than in Europe, which seem to lag behind in terms of policies. Now, we wanted to show you 3 specific asset classes. We've done extensive work to model losses. And we want to show you 3 examples. This is our base scenario for CLO losses, so leverage loan repackaging losses. There's about $740 billion outstanding of such transaction. We expect around 100 billion of losses incurred to investors over the next 2 years, which is 2 to 3 times, just to give you a reference point, to what was experienced in the last financial crisis. This is an example for US commercial mortgage-backed securities. Out of 556 billion outstanding, we expect almost 100 billion of losses. And this is an example for US subprime auto loan asset-backed securities. There's a lot of talk about subprime auto loans being a troubled asset class, and it's true. However, the amount outstanding of such a security is small. So in absolute numbers, we're expecting 4 to 5 billion of losses, which is not much compared to the previous asset classes. So who's going to be affected by this? Very much depend on the type of bonds we are talking about and the asset classes we're talking about. We think hedge funds, insurance companies, and mutual funds or UCITS funds in Europe are going to be affected the most because they're the largest holders of structured finance asset classes. And of course, banks, because they own the raw loans on balance sheet. Hedge funds typically invest in equity tranches, so the most risky tranche of bonds issued by structured finance vehicles. Insurance companies typically invest in mezzanine tranches, triple B, single A type of rating of CLO, RMBS, CMBS. Mutual funds tend to invest as well in mezzanine and senior tranches of bonds. The mezzanine tranches are those in the middle between the highest rated and least risky tranche of bonds issued by structured finance vehicle and equity tranches, which are the riskiest. Now, let's look at very briefly at 3 issues which we expect to emerge and that lead to litigation. Deleveraging, forced liquidations, and derivative products close out. And we're going to look at each of them in turn. So what do we mean by deleveraging? So there's several transactions, and here we made an example for 2 highly popular US type of vehicles, REITs vehicle that repackage, mortgage REIT vehicle that repackage mortgage securities in the mortgage loans in the US, and business development companies. Nobody talks about them, but they are similar vehicles except that they invest in medium-sized corporate loans. These vehicles all work in the same way. They issue on the right-hand side of this chart equity that is listed and purchased by investors, individuals or mutual funds, and short-term loans provided by banks. On the asset side, these vehicles purchase long-term loans. So what happens is that when this, and we've already seen several of these vehicles being affected by this. So what happens when the short-term loans come to maturity, banks are requesting either collateral or request that the loans be repaid. And this leads to deleverage and liquidations, forced liquidation of assets. The second type of behavior is liquidations or forced liquidations. So these can arise mainly for 2 reasons. One, it can be on the right-hand side of this diagram because investors request redemptions from mutual funds or UCITS fund in Europe for liquidity purposes, for example, or because these funds, as I've written in the middle of the chart, have invested in triple B corporate bonds, for example, that are being downgraded and no longer qualified according to the investment criteria of these vehicles, and therefore the vehicles find themselves in a position to liquidate these investments. And we've seen many funds having to liquidate bonds. This will lead to frozen redemption. So many UCITS fund and mutual funds property fund have already frozen redemptions, and to sale of the assets in the open market, which will lead to losses to investors. Finally, the derivatives closeout is another behavior we've also seen in the last financial crisis, and is effectively the banks requesting from the structured finance vehicles collateral or margin calls to cover the risk on derivative contracts that these entities have entered into in order to hedge their interest rates risk, typically. And right now we've got, again, similar to what we had in 2008, interest rates have collapsed, even if from a smaller starting point, because rates were lower entering into this crisis, but they still have collapsed. And this means that a lot of these long-dated swaps, for example, between the banks and these vehicles are now in the money to the banks. The banks are requesting, or they're going to request margin calls. This will lead to asset sales and cash proceeds being paid to the banks and losses being suffered by investors. So now if we look specifically at what opportunities and the timeline of litigation that we see coming from this, we've divided it into immediate opportunities, and we think the portfolio managers, so the managers of these type of entities, the managers of mutual funds, are in troubles now. They are facing this margin call, they're facing the derivative products closeout, and they face a variety of potential claims. So they have at least disputes with the banks they need help with. And that's an immediate opportunity of advising clients in that type of situation. In the next 3 months, we suspect that some of these losses that are starting to accrue as a result of this margin call and forced liquidations are going to feed through. And the first one to suffer are going to be shareholders in REITs and business development corporations in the US, simply because the structures are simpler and there's an immediate hit to the equity investors in those tranches. And last, we think there's going to be bondholders, large group action or class actions of bondholders as the losses feed through the capital structure from the equity tranche up to the more senior tranches of the bonds. We expect that, as we've seen in the last financial crisis, but to a much larger extent, all the asset classes to be affected by this behavior. So depending on the type of investors or clients you're targeting, we see immediate and medium-term opportunity in terms of litigation and advisory. So with that, I have finished the presentation, and if there are any questions, I'm happy to answer them.